So you record.
Okay, thank you very much. All right, so with respect to what we have been doing in our previous classes, we are just going to pick it up from there and then we are going to drive forward. So we have been looking at the balance sheet, at the various, the analysis of the balance sheet. So we have looked at the functional balance sheet, and today we are going to enter the next type of balance sheet, which is the financial balance sheet. As with respect to what we see, we notice that when we take an accounting balance sheet and do all the necessary retreatment with respect to economic and financial treatments, we are going to, the result will be the financial balance sheet. And when we do the necessary treatment with respect to the function, it will give us a functional balance sheet. And then in our last class, we were able to see how we can generate a functional balance sheet from the accounting balance sheet. So the difference now between the functional and the financial is that the main key difference is that with the functional balance sheet, the main elements that they are using there, they are using the original values of, all right. So they are using the original value of the items or of the balance sheet items. But with the financial balance sheet, we are going to be using the net values, meaning with all the necessary additions and deduction, we will end up using the net value. But with the functional balance sheet, that's not the case. We are using only the original values. Okay, I'm sure my light is on. That's great. All right. So I'm going to share my screen quickly. I'm having some slides that we are going to be discussing as we flow. So I can see Junior is no more in. So I'm sure it's connection palava. Oh, yes. All right, please just permit me. Let me share my screen. Bang. Voila. This is great. Please, can you see the screen?
Yes, sir.
All right, thank you very much. All right, so today we are going to be looking at the financial balance sheet. Just thank God we are not going to spend much time. So, all right. So as I said, the main objective is of this financial balance sheet is to present the financial situation of an organization or of a company to the stakeholders. So the users of the financial information or of the accounting information, they always need information before they will know the next step that they will take with respect to an organization. So this information is very, very necessary. And this financial balance sheet is also called, we also call it low. Yeah, this financial balance sheet is also called the liquidity balance sheet, right? Because elements here, they are being classified based on their order of liquidity. Altogether, so the elements are being classified based on the order of liquidity. So as I said before, you can see the assets and the liabilities, they are evaluated at their market or their venal value, or that's how they call it. So they are being taken at their net value, what is happening in the market, meaning all the necessary addition, deduction, depreciation, provision, and so on and so forth. All those things are being deducted before they will arrive at the financial balance sheet. So look at, this is the template with respect to the functional balance sheet. The financial balance sheet template is, they are just similar. So the highest thing for you is to understand that what are the balance sheet elements. When we look at the Ohada plan, we know that class 1 to 5 consists of the balance sheet accounts. And then from class 6 now, class 6, 7, and 8 gives us the income statement, right? And then any other class, class 9 for contingency or cost and so on and so forth. So you need to have that in mind. And then you need to have a good mastery of the accounting balance sheet so that whatsoever an element pops up, you know that what the element belongs to this side of the sheet. So when you have that in mind, then, all right. So when you are having that in mind, it will not be a problem for you to really go make the analysis that they are necessary for you to in order to come up with your financial balance sheet. Again, with respect to the functional balance sheet, we saw some retreatment that you have to make before you will come up with a functional balance sheet. The same thing happens with the financial balance sheet. With the financial balance sheet, it is having its own rules, which are completely different from those of a functional balance sheet. So let me move down as we see. So these are the treatment that we have to undergo with the accounting balance sheet before it will give us the functional before it will give us the financial balance sheet. So these are some of the rules here. So based on this, at the end of the class, I will send you guys the slides so that you people can follow. Can even print or you can whatsoever, you can be using it. So I'm going to send the PDF format of it for you guys, because these are the rules here. There are many. So with these rules, you have to obey them. For example, you look at things like deferred charges, they say expensive registration fees and so on. They are being considered as fictitious. Things like goodwill and so on and so forth, they are considered as fictitious. So in the financial balance sheet, they are not going to feature there. Because this thing, for example, goodwill, they are just things that it is being created by the organization. So they have no market value, by the way. Because when they are talking about the actual money that they have, the goodwill is not going to feature there, because this is something that they are going to cut it off completely.
Hey.
So I will send you guys an exercise at the end of this, which has to do with this. This one now will solve it practically in class, except that I will see how it goes. But I just believe that one day we are going to solve it in class, probably our next class, or rather than that, online. Please, is everyone, are we all following? Noise is still coming
Yes.
from you again. Let me read everyone, please. Auntie Mary, please, unmuting yourself, and you are just unmuting yourself. All right.
Sorry.
Please mute yourself. Voila, get yourself muted. All right, so let's continue. So we'll look at some of the types of financial analysis. There are several types. So even ratios now is one. So the various category of ratio now is also a way of analysis. So we are going to look at some of the types, which is what? Horizontal, the vertical trend, and so many others. Please, there are many types. So with the horizontal analysis now, this analysis, you are comparing just the 2 years. For example, you are comparing 2 years or 2 quarters or whatsoever. You take a current year and you compare it with the previous year. And with this analysis, you compare it and see whether you are progressing, you are increasing, or you are not making any move. So this analysis, it is very, very important. All this analysis. The next one that we have is the vertical analysis. So with this analysis now, whether you're using your balance sheet or the income statement, because the result that you are going to be having on your income statement is automatically the same result that you will have in your balance sheet. It's automatically the same result that you are going to have in your balance sheet. So if in case you generate your financial statement and the result in these two statements, they are different, that means you have made a mistake. So you have to look for ways to adjust them. So the next one is the trend. When we are talking about the trend here, it means that you take just the analysis for the 2 years or whatsoever comparison that you are making, and then you make a sketch, meaning you plot a graph to demonstrate it. So your graph here, it depends on the type of graph that you like. So, and again, when you are choosing a graph or whatsoever to make your analysis with it, it's always advisable for you to use something that everybody will understand, or something that will be very easy for people to understand it. So you have to take note of all those things. So that's what we have there. So this is an example of a horizontal analysis. So looking at this, you see this is something that I just screenshotted from somewhere. They are giving you 27, 28. So they are making the comparisons of the body year to see if in case the company is at the same stage, or the company is going back, or it is increasing. So if, I don't know if you can see, you will notice that the 2017, for example, the rental operations, it is 847,000. And here we have 801,000, meaning here it has instead increased, which has led to a percentage of this. So to know the percentage, you take what the current year minus the base year and you divide by the base year. You determine the percentage at which the thing has increased or the item has decreases. All right, so move down. The vertical analysis, same. Trend analysis, same, and so on and so forth. So that's all about that balance sheet stuff. So what is lacking now is left now for us to solve an exercise that has to do with the financial balance sheets, where we are going to see how these our conditions are going to be applicable. After that, then everything is settled. So I just believe that I'm going to send you guys an exercise at the end of this. So the next thing that we will start looking at, I don't know if we are going to finish that today, is ratio analysis. Ratio analysis. So in the recent, when we talk about the ratio, even at the level of your mathematical level, at the level of mathematics primary school, they say ratio, you are comparing two things, right? And that's basically what the financial analysis is all about. So the ratio is just like a tool or a technique that is being put in place to evaluate the financial health of an organization. It is there to evaluate the financial health of an organization. How strong is the business in terms of finances and so on and so forth? Or how does the business flow? So it is with respect to ratio analysis that people will know if this business is doing well or the business is not doing well. Before somebody will invest in a business, the person will, they always try to look at the financial statement of that business, and then they look at the various ratios that they have calculated to see if the business is actually doing well or the business is not doing well. So there are several categories of ratios that we are going to be looking at. We have the liquidity ratio. We have the profitability ratio, solvency ratio, market ratio, turnover ratio, and so on and so forth. There are several categories of ratios that we are going to look. So each ratio is having its own way of calculation and it's having its own formula. So the secret behind it is just for you to understand what the ratio is talking about. If you are capable of grasping what the understanding what the ratio is all about, it will become very easy for you to know how to analyze it. For example, when we talk about liquidity, what does it mean? When we talk about solvency, what does that mean? When we talk about profitability, what does it mean? When we talk about exigibility, what does that mean? Right? So these are concepts that you need to become used to, so that whensoever such words are being mentioned, you should not become like whatsoever. You should become used to them as an accountant or as somebody that is on this journey. So you need to understand, when we are talking about our liquidity, we know that it refers to the amount of funds that they are present. So with the liquidity ratio now, we are going to be calculating to see if actually the company is financially, or the money is actually available, the physical cash, if the company is having that cash. We look at the profitability, meaning the ability through which it can make its profit, right? Market turnover, sales, the way through which the company can be making its sales. Is it possible? Because all those things, you have to consider them as an investor, or consider it as before you partner with somebody to see if normally, or if in case they are generating the required sales or whatsoever, or what you need to consider all these ratios before you invest in somebody's business. All right, so we'll be looking one after the other. The first one, types of ratio analysis. The first one, we have liquidity ratio. So we say that it measures the firm's ability to meet its current obligation. And we have several categories of liquidity ratio. And we are going to look at the main three, which is the first one being current ratio. That's the first type of liquidity ratio, which is current ratio. So it is just what the comparison of our current asset to current liabilities. That's why it is determined using the formula, as the formulas are being displayed on our screen. We have current asset with respect to current liabilities. And if in case we have a very high current ratio, it proves that what there is, if we are having a very high current ratio, it proves that there is an inadequate employment of funds. But it does not mean that the company is dying or the company is not dying, but it is normal. That means they don't have that high debts, meaning the available cash that they have at hand, they can use it in order to cover up all their short-term obligations, right? Short-term obligations here that we are referring to the current liabilities, meaning what they are having at hand is capable of covering all this. So having a high doesn't mean that it's bad, it is good, but we classify it as what it is due to what inadequate employment of funds, right? So we talk about the employment of funds, which is the liability, which they are funding their asset side. The next type of ratio that we have is the quick ratio. So quick ratio is just similar to the current ratio, but the only difference here is that what inventories is being deducted from the current asset. And why is this inventory deducted? Because the inventory at times it is doubtful. They don't actually know when they are going to sell the inventory. So due to this, since they are doubting, they are going to cut it off from the current assets. And what will be remaining will just be the current asset, excluding that. So that what is available, to know that what this thing that is available, they can easily convert it to cash. Or what is available, there is already money, since we have cut off the inventory. All right. The next type that we have the cash ratio, which is made of the cash and the marketable security. And this cash ratio, it is very useful when what? When our debtors are doubtful. So when debtors are doubtful, they understand it with respect to the cash ratio. Your debtors are doubtful, you don't know if when and or if they are going to settle you. So when their debtors are doubtful, that's when you start what the process of provision. You start providing for them. You see that this your debtor or his business is already going down. You see that you have to start providing for. You see that if at the end you can recover, let's say 20% of what the person is owing you, you start providing for the 80%. So that at the end of the period, if the person does not fails to pay you, it will not affect your business in one way or the other because you have been providing for that. You just take the money and substitute. Are we together, please? All right. So the next type of ratio that we are going to look at is the inventory turnover or debtors turnover ratio. All right. So the first one, I have the inventory turnover ratio. So with this other ratio now, it is going to measure your turnover with respect to your average inventory. We are using the average inventory here. We don't use only the inventory, but the average inventory here because the inventory are throughout the entire life cycle or throughout the entire period of the business is not going to be constant. So we always calculate by the average and we use. If in case you have been giving, for example, if in case you have been giving with things like the opening stock, you have the closing stock and so many other elements, you have to calculate by the average stock. And the average stock in this case, let me see if the formula is even there. Yeah, the formula is not even there. So the average stock in this case, we calculate it by taking our opening stock plus the closing stock and we divide it by 2. So you can jot it down. That's how we calculate our average stock or average inventory if in case it's not given. So we compare our cost of goods sold with respect to the average inventory in order for us to have our inventory turnover. And the next one is the
please give the formula again that you just gave.
Of opening stock plus closing stock. Opening stock plus closing stock. Opening stock plus closing stock divided by 2.
Okay, thank you, sir.
Welcome. All right. So the higher this ratio, it is better for the company to generate more profit at the end of the period. The next one is debtors turnover ratio. This one is we measure it using what credit sales with respect to the average debtors or debtors. If in case you don't have average debtors and you have debtors, you use, or we say debt, or we can say that debtors turnover ratio, or we say debt turnover ratio, whatsoever. Right. So this one enable us, we know with this ratio, it costs us to know the ability, or the rate at which our debtors can be able to settle their debts at due time. So that's the importance of this debtors turnover ratio. Another one that we added is what? Net assets turnover ratio. Yeah, this one does not even belongs here. So this one we measure using what? Sales over net asset. So in this case, you have to calculate the net assets of your organization. Let me see. All right. Okay, please. You guys should unmute your mics and talk. I'm seeing my content is finished from here. I didn't. Hello, please. You guys should, should unmute yourself and talk.
What are we talking about?
What are we talking about? I just discovered I didn't include the profitability ratio here and the solvency. Yes, Leader Junior, the delegate. Yes, Makani.